Welcome to the Regulatory Nomad, your source for compliance strategies in global finance. If you earn income while traveling, you've heard the golden rule. Stay less than 183 days in any country and you're safe from tax. This rule is dangerously incomplete. It's the biggest misconception leading remote workers into unforeseen legal and financial liability. Many travelers are unknowingly exposed to global tax liability because they fail to prove one crucial thing. Where is your legal tax home? Ignoring this complexity turns an exciting life of freedom into a massive, escalating legal risk. Today, we'll break down why the 183-day rule is a trap, how tax treaties define residence, and steps to avoid being taxed by the country you left behind. The core issue lies in confusing two distinct terms: physical presence and tax residency. The 183-day rule only defines physical presence. Spending under 183 days in a country just means they might not claim you as a tax resident based solely on days. The real problem starts when your home country decides you never severed ties, or when two or more countries simultaneously claim you as their primary tax resident. This scenario is called double taxation, meaning both countries legally believe they have the right to tax your worldwide income. You end up paying full taxes in both jurisdictions, sometimes amounting to over 100% of your earnings. If you haven't established clear tax residency, most countries will default to taxing you based on old ties. You become a tax tourist. To prevent this chaos, major global economies rely on the OECD Model Tax Convention's Tie-Breaker Rules. These rules are applied in sequence to determine where an individual truly belongs for tax purposes. The 183-day count is irrelevant once this check begins. First, the treaty asks, where do you have a permanent home? This means any dwelling continuously available to you. If you keep property in your original country, that location remains a strong contender for your tax home. If you have permanent homes in both country A and country B, or in neither, the tax authority moves to step 2. This is the most critical step for global workers. The treaty asks, where is your life centered? Authorities will look for evidence of your center of vital interests, evaluating family ties, financial assets, social ties, and business interests. For the permanent traveler who hasn't fully committed to a new location, this analysis almost always points back to the original departure country, pulling them back into that country's tax net. If the first two steps fail, only then do they look at your habitual abode and finally, your nationality. But steps 1 and 2 are the real battleground for remote entrepreneurs. To eliminate the permanent traveler tax trap, you must execute a comprehensive exit plan. This plan focuses on dismantling your center of vital interests in your old tax home and establishing substance in a new jurisdiction. Here are the 4 actionable steps every permanent traveler must take. Sever all financial ties. Action: close old local bank accounts, sell or rent property, and liquidate local investment holdings. Move assets to non-resident accounts. File your final non-resident return. Officially notify your original country's tax authority of your permanent departure. This is a required legal formality. Establish intent and substance. Commit to a new location. Get a long-term lease, open a local bank account, and obtain local ID in a new, tax-friendly country. This creates your new center of vital interests. Document everything. Keep records of flight manifests, lease agreements, utility bills, and local insurance policies. Proof is your shield. Tax authorities rely on documentation. Remember, simply moving your body and counting days is not enough. You must move your life, your interests, and your paperwork. The global tax landscape is complex, but manageable with clarity and documentation. The key is understanding these rules are about intent and evidence, not just counting days. If you found this breakdown valuable, subscribe to The Regulatory Nomad for weekly analysis on global finance and compliance strategy. For an immediate start on your exit plan, click the link below to download our free guide, The Top 5 Easiest Tax-Friendly Countries for Digital Nomads. Thank you for watching, and we will see you next time.